think so, Azar. I mean, whenever you buy or it's kind of funny. Like you make a trade. Okay, you make a trade because I mean, well, let's say this is the stock price. Okay, whatever. And this is kind of stochastic, but it's sort of supposed to go around this like fair value expectation you have, right? So let's say you got this fair value expectation. And you can see the deviations above and below the fair value actually going to make it a straight line because when we make a model or a fair value, like we don't have a like I wish this was bigger, thicker. We don't have like we're not like constantly updating it, right? Like we might update it, we get some more information, but it's a step function, right? So like let's say we got more bullish, they had a good product update. We would step function like up here, right? And then it would stay the same. And maybe they had a good quarter. So we would step function again. And here's where the delta, you can see that the delta is never big enough to take action. Like, okay, that's a little bit overvalued. Here it's a little bit undervalued. Here it's a little bit overvalued. Here it's, for a little while there, quite undervalued. Like at the very bottom there, maybe it's undervalued enough. Same thing here. And then finally here at this price, this is where maybe we take action. This is some arbitrary percentage, some delta that is big enough that we want to take action, right? And so with that arbitrary amount, we want to make a trade. Great. Now here's the problem. We got in this trade, right? Because the fair value that we've estimated, which is the green line, which is absolutely just an imaginary number, right? We came up with this fair value based on our best guess. So it's a guess. It's not, some, set in stone thing. And the whole market has more or less the same information we have. So this number, this point, is just our guess as to what fair value is. So now we bought the stock because it's down here, right? This is the market price. This is the real price, really. And again, our odds are against us. The academics say there's an efficient market. All the information is known by everybody. There's thousands of hedge fund guys sitting there doing the same thing we're doing. So why would we buy it? Well, we have a lot of conviction that the green line is where it should go and it'll go over time, right? But this is the price and it's moving and it's going to keep moving. And there's stochasticity in the market because why is there stochasticity? Well, one of the major reasons there's randomness in the market is the traders in the market will make trades that don't necessarily reflect, one, what we believe, but also good decisions, right? They may pressure the market with a large sale or a large buy, and that increases the randomness. So whatever this is, you have like a major variability around it. If it's a really like volatile stock, you have a huge variability around it, and you have to expect that. So we make the trade. Why should there be any expectation that this trade will close, the arbitrage will close at any given time? There is none. We think it'll close with time, but we certainly don't think just because we put the trade on that it'll start to close, right? That would be, I think, a little bit wild. Now, people think they can do that. That's called timing, market timing, right? But the problem with that is it has a bit of a fallacy to it, in my opinion, because you're also saying that at this price, at this delta, okay, I'm willing to take action. But does that mean at this delta, you're not also willing to take action? It's more attractive here. This is one theory of markets. It's not the only theory, as we know. But this is also an attractive delta. But ironically, by being willing to buy at the red delta, you're basically and you're willing to buy at the orange delta or the yellow delta, you're basically willing to say that I will, double down or increase my position as it gets more attractive. Now, in trader land, that's a no-no, right? You don't double down. But in investment land, it's gotten more attractive. It's deviated from the green price even more. You can argue like this is, take Sarepta, for example. Or you can argue this is short, just go the other way around. So when I buy here, am I expecting it to close? Well, by definition, I wasn't expecting it to close if I'm willing to buy more down here. But what drives this movement? What drives the ARB closing, right? It's the other traders realizing that this is the right price. Sometimes they might never realize it. What's going to force them to realize it? This is sort of catalyst or psychological trading thinking. And the markets are really run by psychology. I don't like the word catalyst, but I think the idea of traders moving to what you think is fair value over time, when you have this style of investing, you have to be willing to be patient because you were willing to buy based on not a psychological deviation, but a fair value deviation. There are people out there that don't believe the idea of fair value even exists. So if you're subscribing to this market style of investing, which is like a Buffett or private equity style, Chris Hone, Elliott, but it's not for everybody, then you are basically kind of willing to say you don't care about timing and you don't care about market psychology because at the end of the day, the deviations in market psychology were what you are exploiting to make your money. If you could predict them, you would not have set the trades like this, right? You would have actually shorted here because you knew it would get to here. You would have set 2 buy orders. You would have set a sell order here and a buy order there. And you wouldn't even worry about the green line. You wouldn't even think about it. So, there's a lot of philosophies, and some people can make money trading the psychology. I like to make money the way I've shown you for months and months, which is to sort of do my research, look at what I think is the fair value. Now, what is fair value to me? Fair value is the price a rational owner, a rational trader, really an investor, would pay to buy the whole company. Not to trade 500 shares, but to buy the whole damn company. Something I've done many times in my career. And if you look at how Buffett operates, right, he's gotten so good at capitalism that he can only buy whole companies, and he can only buy really big companies. Even early in his career, he was buying companies. Just 6 or 7 years into his career, he was buying full companies. That's how good he was. Right? And Buffett didn't have special access to some zillionaires. A lot of his investors were guys in his neighborhood. So, you can go from zero to hero if you're very, very good at what you do and you're very disciplined. People will look at you and say, wow, I want to give my money to that guy. He knows what to do better than I do. And he seems like he's got a good head on his shoulders. You can do it too. But, that's the value investing style. That's the private equity style where you say, this stock can't trade below, Sarepta can't trade below 35. Guess why? I would buy every share outstanding. That's why I can't trade below 35. So fuck your psychology and your theories because I'm willing to buy every damn share and take over the whole company. That's where PE redraws the lines, and there's no answer in technical analysis for PE. There's no answer for takeovers, right? The price is gone, the line is gone. So that's why I think technical analysis doesn't really make sense, or market psychology, right? Even market psychology doesn't make sense. The best thing you do is abuse and exploit market psychology, not sort of fear it. You want to be there to abuse it. By abusing the market psychology, you can exploit it for your own benefits. Well, like I said, IoT. So Buffett doesn't worry about the market seeing anything through, right? Buffett worries about. Ooh, Lays could be a good short. Yeah, we're short. We're short capper. We increased the fund amount. We didn't double it quite, but threw in enough to make Schwab happy. Um, so so when Buffett buys a stock that's below fair value, he's not buying it for a return to the green line, right? This is really important. Why is Buffett buying, when Buffett buys a stock, why is he buying it? This is a good question. Who's got the answer? Come on. Ken's got it. Cash flows. He's not buying the stock because he's hoping the stock price goes up. That's not that's silly talk to him. He doesn't care about the stock price. He needs the cash flows. He wants the cash flows. Right? So let's say you got successful at biotech investing. I know people that have done that, right? That have gotten so good at investing in biotech, they got a big stash of money. Now, let's say they bought all of Sarepta, they owned all of it. So now they don't care what the stock price is going to do. There is no stock price anymore. They own all the shares. Stock price is meaningless. What do they own? They own a bunch of drugs, right? Well, what's the use of owning a bunch of drugs? The cash they'll generate, right? So if the company has 4 billion in revenue and has a billion in costs, that's 3 billion a year in cash flow, right? And if you bought all that for 3 billion, well, you probably made 10 times your money if you discount the cash flows, right? And what's more important? What some traders think in the market, or you making that cash flow? Well, obviously to Buffett, his whole game is how much cash flow can I make? The value of my company is how much cash does it generate every year, right? It's not what do some traders think. Let the traders give me a gift. They're giving me a gift. They're saying, Mr. Shkreli, Mr. Buffett, or whatever your name is, Mr. Chat, I want to give you $1 every year for the next 20 years. And you say, well, how much, Mr. Market? How much? Is that going to be $10, $20, $5? And Mr. Market says, well, for Sarepta, it's $1. You say, you want me to buy a stream of cash flows of $1 or more every year for $1? And Mr. Market says, yeah, I'm willing to sell you that for $1 right now because I'm losing my mind. So, okay. And you buy the stock that somebody else sold at 35 or whatever it is. So, that's kind of, the point of investing down the road. Now, you might listen to this and you say, Martin, I got 50 grand. You might listen to this and say, Martin, I got 5 million. How the hell am I going to buy a whole company with 5 million? And 5 million is probably more than most guys here, but I'm sure for some of you it's less. But for most people, it's more. And you say, what am I going to do with 5 million? That's nothing. I can't buy big companies with that. Well, no, you can't buy big companies with that, but you could buy small companies theoretically. But the key thing is whether you're buying the whole company or not, that you still think this way. And if you stay thinking this way, you'll continuously succeed to the point where you are buying small companies. And then like Buffett, you'll continue to the point where you're buying big companies potentially. But what most people do is they give up. they start thinking about market psychology and market timing, and they stop honing their most important thing, which is what is this value of this company? Can I get these cash flows for a discount? And the compounding takes care of itself. So that's the theory. Um,